All right, so let's see how Timmy and Sara's plan looks like, given all that they're trying to do. And again, Timmy's trying to retire next year. Sarah's going to wait another 2 to 3 years, if memory serves, and her income is rather small relative to Timmy's, but it's going to go a long way for the next couple of years. All right, and again, the structure is they're going to have to pay out of pocket for health insurance. They have budgeted about $1,200 a month and that's just before copays and stuff. On top of that, they're going to take a reverse mortgage when they hit 62, when Timmy hits 62, in order to pay off the remaining of their first mortgage that they have. They don't have another line of credit or anything like that. So it'll be interesting to see how this shakes out. So let's dive right into it. And the first we see here is we got a 99% probability of success under the proposed plan. Actually, when did they take Social Security? Let's take a look here. Bear with me just a second. I forgot when they took Social Security. So let's see what they're thinking here. That's 67 for Sara and 67 for Timmy. Okay, gotcha. All right. So let's go to, let's see why they got proposed plan 99% with a median net worth of 2.94 million. And that'd be liquid assets. And as you can see here, that blue vein is a median. That means 50% above, 50% below will be their blue vein in terms of liquid assets. And you can see when they're how old is it? Let me move my mug out of the way here. So when they're 70, when Timmy's 70 years old, they'll have a median liquid net worth of $990,000. And which means 50% of the time they have more than that, 50% of the time they have less than that. But not at any one case do they have zero. All right, not one time do they have zero for a liquid net worth. Now, I will tell you the issue here with the reverse mortgage, and I'm going to show you here in just a second. The reverse mortgage allows more of a liquid net worth, but it takes away more of your not total net worth, your real assets in your home. All right, so see, this is what I think is favorable. Actually, I mean, think about it. What is your house appreciating at? Well, it's appreciating at 1 or 2. They're saying 1%. Not more than that. It's just not. I mean, are there some places in San Jose? Sure. Are there other places in Erie, Pennsylvania goes negative? Absolutely. So you got to be careful there. All right. So if your house is appreciating at 1 or 2%, and the debt that you have on your home, well, it's actually if your house is appreciating at 1 or 2%, and your equity, your stocks, and your mutual funds, and your liquid net worth is appreciating, hopefully more than that, it only makes sense then to not have your house as your appreciating asset, but to have your liquid cash flow, your liquid net worth as your appreciating asset. Does that make sense? Because it's simple arbitrage. I'm getting 2% on appreciating of a home, and I'm getting 5% on appreciating assets for liquid net worth. Now, in this case, the asset base is actually not on the home is actually not even appreciating because I'm getting 1 to 2% a year appreciating asset, but I'm paying 5.5% because I took the home equity conversion mortgage, the reverse mortgage. We'll show what I'm talking about here. So in that case, I'm getting it's costing me real assets in order to allow my liquid assets to grow. All right, so let's dive into that. But anyway, as you can see, in this structure, they're not run out of money at all. So let's go to probability. What happens? We're going to hit this action item. What happens if we take Social Security at 70? So we're going to take Social Security at optimal, which will most likely be 70 for both of them. What does this do here? And it's going to increase. It's going to reduce our probability of success to 94%. That's fine. And the reason for that is simply because we're tapping into our liquid assets sooner, which means there's more risk to those liquid assets in terms of negative sequence of return risk and things of that nature. But I'm telling you, frankly, if you can get above 80%, I'm fine. If you can get above 65%, I'm fine. And let me show you why. So here, let's just go to income real quick. I always like this. This is taking Social Security at 70. And what you have here is the proposed plan, 78.9% of their income is stable because it's coming from pension is the blue. That's the blue, and then it's coming from Social Security in the purple. So what you see here is you got serious income stability here. All their income is being met from pension and Social Security. Now, some would say, well, that's a risk, Josh, because what happens to Social Security? What happens to the pension? I don't believe it is, but I get that. You know, I don't think that's a risk because the idea that the government is going to renege on Social Security if they expect not to have pitchforks, you don't know who Dan Rostenkowski is. I'm telling you, you don't. The last thing a politician wants Politicians don't want controversy. The path of least resistance to keep them in power. All right, then you can see savings withdrawals. So we're taking money out here. We're taking money out 63, 64, 65 to meet the income that we need until Social Security kicks in big time here. Then we don't have to take it out anymore. And then we got to take it back out here because we'll go into this. This is when one of them dies. I imagine Sara at this case because Sara is a little bit older than Timmy. But, we'll talk about that. So let's go here again. So let's go to, instead of optimal, let's go to current strategy. I'm just curious about the income. Hit refresh. And this will be pretty interesting here. Let's go to income here. And 73%. So, I mean, because they have the pension and because they have Social Security, the bulk of their income needs are coming from those things. And they're not having to take much from their savings accounts. So their liquid net worth, if you will. All right, so let's go to cash flows. That's the next thing I want to do. I want to go to cash flows. And this is the current analysis. We haven't done anything to change anything here. So cash flows, what we see here, and this would be 2020 when Timmy retires. And let's see where their cash flows are coming from. Income flows. So Timmy retires. They're going to have 58,000 from Sara's salary, and Timmy's pension is 19,000. That's going to be their total income inflows. Salary and pension is 58,000. And okay, gotcha. Now Sara retires. The only thing they're going to have is their part-time income, which is basically 15,000 for Timmy and 17,000 for Sara, and then the pension there as well. Okay, so then in 2025, 26, and 27, 2025 and 26, they got no part-time job money. They got nothing coming in, and at that point, it's going to come from all their portfolio. And then in 2027, Sara's Social Security will kick in, and then in 2032, Timmy's Social Security will kick in as well. All right, so let's go back to summary. So they got total inflows 78,000, total expenses of 95,000, tax payment of 15,000. So they have 114,000 as their total outflows, which means they have negative outflows of $36,000. Fast forward to when Sara retires. Here they got negative outflows of $100,000. So let's see what's going on here. We're going to go to expenses. Living expenses is $3,700 a month. Housing is $16,000. All right, that's their mortgage. Their debt, these are the car loans and all that they're paying, and their health care. So they did a great job of calculating what they presume will be their health care. I like that quite a bit. And you can see it drops off quite a bit once they're both on Medicare. But anyway, so that's their charitable giving here. So their total expenses are $95,000. Living expenses $44,000. Housing is their mortgage at $990 a month at $16,000. 990 times 12. 16,000 plus their property taxes and insurance. That's spot on. Their debt to finance those 3 vehicles they have, then their health care. But they also got to pay those $15,000 in taxes because the money's got to come from someplace. So let's look at the tax payments here. All right, so you see federal income tax, state income tax, and FICA because Sara's still working. So in fact, you got, I mean, that's it. I mean, you got 13,000, and the reason why this is jumping up such a much, watch this, their expenses. They're going to have to go, actually, inflows right here. So now they're starting to take a lot more money from their IRAs in order to finance their cost of living. And so their taxes are going to jump up quite a bit in 2021, 22, 23 because they're taking so much more from their retirement accounts. And so if we go to taxes, you can see it jumps up from $6,000 next year in 2020 to $13,000 to $21,000, $16,000. See what I'm saying? See how that jumps up? But then watch. It drops like a brick. Look at that. Look at that. I mean, it drops like a brick. Now, we'll go into that in more detail. But anyway, so let's go expenses. Again, we just want to look at, that's nothing extraordinary. It's just the taxes are a big burden. Let's click on this button right here, and I'll show you what the taxes look like. I mean, look what they've done here. This is fantastic. I mean, they're essentially saying, look, we're going to pay 20% taxes, 18%. 18%, 18 to 20% until we're 70 years old. Then our tax could be basically nothing. I mean, literally less than 1%. And I'd even challenge that right there because everything is a Roth IRA. So what they're doing is they're saying we're going to front load our taxes in order to have no taxes on the back. I 100% think that's fantastic. If we go to details, we'll show you what they're doing here. This is their 1040. So they got wages, W-2, that's Sarah's income. They got Timmy's pension, $26,000 plus any IRA distributions they're taking, which they will be taking some because they got to use those to meet their income needs. So their total income is $54,000 plus $26,000, $82,791. They got $24,400 standard deduction. Thus, their taxable income is $58,000, which means in the feds it's $6,400. All right. Now, don't forget they also had to pay FICA, which isn't reflected here in the individual tax return. So let's fast forward to 2022. Now they're taking big bucks from the IRA. As you can see here, they're taking $89,000 out, and they both have part-time job of making $32,000 of income, but they're taking $89,000 out of their IRAs. And here they got total income $121,000, standard deductions $25,000. So their taxable income here is $96,000, of which they have to pay $12,000 to the feds. And I forgot what we said to the state. It wasn't, I can't really look. Well, this is 2022, so let's go back and see what the state looked like. 2022, we're going to go to cash flows. 12,000 Fed, no FICA, and how much to the state? 2022, 8,000 to the state. Oh, okay, they are doing FICA because they're saying they're self-employed. Okay, so they are taking a little bit of FICA. 8,000 to the state seems pretty high to me. I wonder, they live in Iowa. That seems pretty high. Maybe it's not. So what we might want to do is look at an Iowa specific, and I might have to do that. So let's pause. I'm going to bring up an Iowa thing here, and we're going to see how that looks. So bear with me just a second. I'm going to pause real quick. And actually, let's just see their inflows, their income inflows. All right, we got 20,000 as a pension, and income 20,000 as a pension. Actually, hold on just a sec. Let's go to accounts. Assets. I want to look at the Iowa right here by withdrawals. So they got 2020. They got 69,000 coming from their 401k and 20,000 from a pension. All right. So let's see what the. Let me look up a smartasset.com for Iowa and see what that looks like. So bear with me just a second. All right. So here I am at my website, heritagewealthplanning.com, and as you can see, my pop-up, if you want the email, the PDF file of this book pops up for you, and just fill that out now, and you'll be on my email list. So easy as pie to do. We'll click out of that. And so what we've done here is we've gone to Tax Tools, Interactive Tax Page. We scroll down to Smart Asset right here, and we're going to click on Iowa. And what did we say? We had, for a pension, we had 20, what did we say for pension? Income flows. We had 19,548 from a pension, and we had 70,000, I think was from IRA, 70,000 from IRA. So, but we're just going to say 20,000 from pension, 70,000 from IRA. Let's see what the thing here says for Iowa. So we're going to say year of birth, we'll just say 1965. All right. And we're going to say nothing from Social Security. We're going to say we are married because we are. And we're going to say we had, I think, 32,000 in wages. We had nothing from Social Security. Retirement income. We had a pension of 19,000 and 80,000 from IRA distributions. So we're going to say 60,000 from IRA distributions. We're going to add a, why does it keep changing for me here? We're going to add a pension, and I don't know if it's public or not, so we'll just say private pension, and we're going to say, what is it doing that? Married, it keeps changing on me, man. Yeah. 20,000, married, $20,000. All right, we got nothing from Social Security. We got, keeps changing on me, driving me up the wall. All right, I'm not sure what's going on there. We're saying we're married. Maybe wants us to have some Social Security. All right, so let's just say we're married. We got annual retirement income. We're just gonna say $80,000 for simplicity. And I don't know why it keeps wanting me to have Social Security. So let's hit enter, and it keeps defaulting to single. Why is it doing that? It is weird. All right, so we got an issue with the software here, but so I'm not sure what's going on. But anyway, at the end of the day, hold on a second. So I just went to the source at smartasset.com, and they're saying on 8. It looks like they changed around the software, which is fine. But it's actually, I think they step back. This isn't as good as it was before, that's for sure. But anyway, they're saying, look, you got $80,000 of household income. You're married with 2 personal exemptions. That'd be you and your spouse, Timmy and Sara. You have $3,900 of state income tax. So that's a lot less than what Right Capital is showing here for state income tax. And let me show you what I'm talking about. They're showing $5,000. So that seemed a little bit on the high end, actually. Actually, no, they're showing $8,600 here. So I'm not sure where that's coming from. That seemed a little bit on the high end. But be it as it may, we're going to err on caution as opposed to err on aggressiveness. But that still seems that's pretty high. So what we're going to do is we're going to look at summary, and we're just going to go back. Look, we got $100,000 of net flows. We got to have it coming from someplace, and they're showing us some pretty significant tax payments: $107,000, $100,000, $103,000, $127,000. So you can see all that, the tax payments for sure. And the reason for that is because we're doing Roth conversions. So let's go back to accounts. Let's go additions to accounts, and what we're going to show you here is Roth. So here's when Timmy converted his entirety of his 401k to his Roth right there. Now he's doing $65,000 a pop, 65, and he's adjusting it at 4% each and every year until that sucker is completely exhausted from his traditional 401k, and now it's in the Roth. So by the time he is 71 years old, he's got nothing in the regular account. It's all in the Roth. Watch, this is sweet. So I mean, look at this. By the time he's 70 years old, everything for he and Sara are in the Roth IRAs. Everything. Tell me, I mean, that's awesome, man. Look at that. I mean, it's fantastic. So because of that, what's happening here is now they have more income coming in than they're spending because they paid off all this debt, all right? And what's happening here is they're adding to their taxable accounts their excess cash flow, $12,000, $20,000. So basically, they have $12,000 a year in surpluses, which are being invested each and every year. And so when they die at 90 years old, or 88 for Timmy and 93 for Sara, they got $50,000 in a taxable account and $4 million in a Roth IRA. I mean, that's just fantastic. But let's go to net worth, because everyone's going to say, yeah, but you forgot about the reverse mortgage. Oh, no, I didn't. Let's look at net worth. This is what makes the reverse mortgage, in my opinion, kind of interesting. All right. So look, we're going to have all these mortgages paid off, right? So we got the first mortgage paid off, and all other loans are paid off, except for when they're 61 years old for Timmy and 66 for Sara. The only thing that's left is the reverse mortgage, and that's growing at a clip of 5.5%. The home is only growing at a clip of 1%. So watch. By the time they die, the house is worth $347 and the mortgage is worth $646. Guess what? That is going to come off their total net worth, this right here, because their total net worth consists of assets minus liabilities equals total net worth. And we can see here net worth is $3.6 million. Well, how could that be $3.6 million when in fact we know for a fact I guess we show this right here. We got this right here. We got a house that's worth $350,000. We got a Roth IRA that's worth $4 million roughly, and then we got a regular account that's worth $50,000. So we got almost $4.4 million. No, we don't, because we got to subtract out the home equity conversion mortgage, the reverse mortgage. But guess what? $3.6 million is our total net worth. How much of that is truly just going to be evaporated? Well, half, because the only thing we have to owe is $347,000. We cannot owe more than the value of the home. That's the thing with home equity conversion mortgages. You can't owe more than the value of the home. So in this case, it is growing at a 5.5% clip, whereas house is only growing at a 1 or 2% clip. So we fast forward, and he owes $650,000, but the house is only worth $347,000. So when they die and leave it to the kids only are going to have to come up with the difference. They're just not. So they're going to inherit 3.9 tax-free, $50,000 IRA, and then they're going to lose the entirety of their home, but they're still going to inherit almost $4 million tax-free. Does that make sense? As opposed to what this is saying at 3.6. That's, man, I mean, I just think it's fundamental. I love it. But you're running into the debt scenario, and well, you're not. I mean, well, you are, but who cares? Because you have all this growth right here, $3.9 million, that's tax-free. Tax-free. And all it will do is transfer via beneficiary designation. And because it's a Roth, it's tax-free. And it's not like you didn't pay into it. I mean, you paid when you took out the reverse mortgage, you had to pay 2% on top of the entirety of the home value. All right, that's what it costs, 2%. And then you got to pay closing costs and if it may be origination fee. So I'm a huge fan, as you can tell. I love it. I think it's fantastic not to have any taxes due. Now, people say, yeah, but Josh, what's the likelihood of your investments growing the way that I'm anticipating? Well, I'm going to show you. I'm not shooting for this, shooting for the moon here. I'll show you exactly what the anticipated returns are. 6.8% on an aggressive portfolio. 6.8%. That's before inflation. And don't forget, inflation's at 3%. Social Security is only growing at 2.6, all right? And on top of that, Medicare costs are growing at 5%. So our expenditures are growing almost twice the rate of our Social Security growth is, simply because that's what the trustees report says. Our returns, which are 75-25, a pretty aggressive portfolio. I'm only anticipating 7 to 7.5% in stocks and 3.5% in bonds. That's it. And I mean, so net of inflation, that's Timmy did a great job. Timmy did a great job in putting in what these numbers are for sure. And I think it's fantastic. So anyway, hope this helps. A lot going on here. I get it, but it's pretty good, man. And I'm a big fan. I hope you get a lot out of this for sure. I'd love to hear your thoughts on this, especially on the reverse mortgage. I know there's a lot of controversy on reverse mortgage, but man, share your thoughts. And don't forget to subscribe, and we'll see you next time. Thanks now.